Hello, Jonathan Plant here from the markets analysis team at Alpha Capital Group. Most people call me Planty, so please use that as we go along. I'm here today to give you an introduction as to what we're thinking about the markets, how it might be of use to you in your trading, and try and demystify some of the jargon that's out there, and let you have a look at the sort of charting that I'm using currently. And there's some quite interesting things to look at there. So without further ado, let's have a look at what's been going on in the markets. This is the Alpha Capital Group market analysis, week commencing 18th of December 2023. So to me, let's do a little quick run through. The markets seem to be a little bit like Jack Nicholson here in the movie The Shining, that he's been hammering away at the door. He's coming through and the Fed stuck inside have got nowhere to run to. So let's have a look at if there's any trends that continue that or argue against that from what we've seen so far this month in the macro environment. I'll then look to summarize how that has affected the markets, and then finally have a look at some charts which I think are interesting currently and into the early part of next year. So what has been bothering the markets this month? Obviously, it's December, it's the end of the year, and we've got such a lot happening in the early 2 weeks of the month. First of all, we had the non-farm payrolls report, the big one, the US jobs. That was a week last Friday, quickly followed by US CPI 1 day ahead of the US Fed meeting, the FOMC meeting. So obviously that was going to create a bit of volatility. And then we've had all the central bank meetings and interest rate decisions around the world. And we'll go over the most poignant ones of those. So default case going into this month was that the markets were a little bit ahead of things. The data wasn't suggesting that we needed rate cuts as quickly as what the market priced in. But subsequent to what's happened in the last 2 weeks, it may still be the case that the dollar is free to fall. We'll discuss all that in the next few slides. So just looking at that non-farm payroll print, I mean, it's now old news relative to market, but originally when that came out last Friday, the first move was wrong, which it generally tends to be. So the markets panicked a little bit. It came out slightly hawkish. The dollar shot up, and the indices futures all came off. So why did that happen? Well, there are two reports when the jobs come out. There's an establishment report, which has got the non-farm payrolls in, and then there's a household one, which builds up from the bottom, shows you all the sectors, gives the unemployment rates, how many people have signed on, etc. So net of those things, non-farm payrolls came in higher than consensus. Revisions to previous months were lower than what people had hoped to see. Wage data was solid. So in general, the overall environment suggested the market was quite firm. The jobs market was firm. So you'd expect Powell going into the interest rate decision to be pushing back on early interest rate cuts. Again, from the household report, not doing what the market wanted to see. It was suggesting that the number of unemployed was smaller than expected. The number of people signing on to start jobs was higher. So put that equation together, unemployed divided by number of people available, and the unemployment rate was really low, came in much below consensus. So everyone's thinking hawkish report, time to push back, rein in the bullish chatter of the market. So next on the blotter is the US inflation figures, US CPI. If anybody wants any of these things breaking down more simply, we can cover them in future updates. So consensus going in was that the Fed was done. There's no more interest rates to come. The inflation figures have all dropped across the globe, really, quite aggressively. UK particularly had said the political policy was to halve inflation, and they've done that. So similarly here in the US, no more rate hikes expected, and data supposedly going to come in line, and it did. Last Friday's jobs report got everyone a little bit worried, but no, we still had an inline print at 4% CPI. Core goods inflation has been falling. We've seen that. Services inflation is a sticky one. That includes rents, housing rents, and wages from the services part of the economy, which is the biggest part. So that is where they need to do most of their work going forward. But it's no longer about what the overall headline inflation and interest rates is. It's about real rates, the combination. So real rates is the interest rate after you've allowed for the inflation. So real rates are taking the interest rate in the economy, so 5.5% Fed funds rate, take away the US CPI 4%, and you're left with 1.5% or 150 basis points. This is really something to think about in terms of is that too tight or is it too loose? And the market tends to think 2% plus is really restrictive. If inflation's still going up, then that's fair enough, but it's obviously going the other way, and that's why the market is pushing against the door so aggressively. It sees 150 basis points of real rates too high and likely to come down to below 1%. So that's why the market is ignoring anything other than a miss on the inflation prints, an outright shock. We've got the market gliding down to where we want it to be, which is being interpreted as a soft landing. They call it Goldilocks, not too hot, not too cold, perfect scenario, and that pretty much looks like where we're at. So we're on to the main act of the week, really, the central bank frenzy. But perhaps we need to introduce the players. And already this year, it feels like there's been too many central bankers meddling in matters. We want them to move out of the limelight, fade away. Top of the tree is Jerome Powell at the Fed. He'll be speaking, they'll be meeting on Wednesday and releasing at 7 o'clock, and they did. Lagarde at the ECB, probably so far this year, they've been the most underwhelming. Bailey, he's got the impossible job. Ueda's come out of nowhere this week. We'll discuss why and what the ramifications are of that. And then there's China in the background, which all of a sudden is reintroducing stimulus. We'll have to consider what all these mean in total and discuss what happened at the meeting. So the star of the show for the week, Jerome Powell. I've been asking for a number of weeks now, has Powell lost the dot plot? So you have the interest rates, we've talked about that. You've got the inflation. One of the other main things that comes out of the Fed meeting is every member gives a plot of where they think rate changes are going to be and what month and how much, when like literally like creating a graph creates a dot plot. So recently the market has been hammering away at the door, 100 basis points priced in by the end of 2024, and Powell and the team are only talking about 50 basis points. So this week's result, we expected them to push back, try and make the market come back towards closer to 50, and instead what they've done is they've said they see 3 rate cuts during 2024, and not surprisingly, the market's gone, blimey, if he's going to roll over like that, then we'll push it a little bit harder. And they've now priced in 150 basis points and counting. You can see here going in to last week, the US was pricing 110 by the end of the year. Japan, only country in the world looking to see an interest rate change, and that's something we're going to discuss in a short while. UK, they had nearly 80 basis points baked in by the middle of the year. And not only was the first hike priced in for June, that's now been brought forward to March with almost a full point priced into the US market by March. I'm saying here, some people are actually looking for 275 bips. Why that just seems ridiculous, doesn't it? Remember, we talked about real rates, and if people really do see inflation coming down to its old trend rate of 2%, then there's no way that rates should be 350 basis points higher. We said we want to see them below 100 basis points higher. So you can easily see how 250 to 300 basis points could come off. But that is the extreme bullish case for next year. So a number of points to think about you'll hear in the headlines, and they're the things that are going to be driving where the market view of the dollar and interest rates are. Can Powell deliver the immaculate disinflation? Quite timely for this time of year, I suppose. But that's basically, can he deliver inflation of 2% after the record QE that we've seen and the COVID layer that was put on top quite unnecessarily, which has created all this inflation. So given all that, can he actually get rid of the inflation without destroying the economy? And that would be an immaculate disinflation, given the background. Almost impossible, most people think. So in the meantime, most people hid away in the money market funds. So back in February, March, when the Silicon Valley Bank problem started, there were about $3 trillion in money market funds. That's since gone up to $8 trillion, not surprisingly, given that interest rates have gone up to 5.5%, and you can play around and get higher than that with the right instruments. But given that we're now seeing the market price in interest rates coming off, that's a point where we've got to start thinking, is it coming out? And in fact, this week saw the first big, decent outflows, 100 billion came out of money market funds and into equities. So not surprising, people are talking about having a melt up in the stock markets. Any of the reasons why Powell may have done what he's done? Well, he's already in a tightening phase. They're doing QT, which is quantitative tightening, not quantitative easing. One involves creating balances at the Treasury to enable them to buy up bonds and instruments that are underwater, and in reverse is quantitative tightening, where they're trying to remove excess cash in the economy. They do that by letting instruments they own expire and then just running off the balance sheet. Inflation itself, the debate is always whether it's going to be transitory. Why do people use language like transitory? Effectively, it means temporary. It was going to be short-lived. A lot of it was done by supply shortages post-COVID. It's not become embedded, so it's not in the system for too long. So if it's only transitory, it means that he can rest easy that it's not going to come back unless there's some kind of external shock, and he'll react again. So hence, we can start coming back towards the market, 75 basis points. Some people think that's dangerous, but we'll have to see. So is it safe to just keep front-running the Fed? By everything we've discussed so far, it looks like it's an absolute one-way bet. And no Fed governor wants to be tightening into a growth slowdown. Effectively, the market's bobbing along. We're looking for that Goldilocks. It's not too hot, not too cold. So the rates have got to come down. But all along, what have the Fed said? They've said they don't want to be Mr. Burns. I mean, look at this character. Sometimes he's good, but mostly evil. And in effect, what the Fed don't want to be is the governor of the 70s, Arthur Burns. He is reviled for letting go of the inflation reins, the interest rate reins, just as the oil crisis was taking off again. And that led to Volcker having to come in the 80s and absolutely smash the markets to bits with double-digit interest rates. So it's quite interesting that we've seen such weakness from the Fed at the first instance, but only time will tell, I suppose. So on to Europe. Lagarde, my favourite. Look at that bewildered expression. That seems to follow around wherever she goes. IMF, ECB. Does she know the score? I mean, the ECB were likely to underwhelm. That's what they normally do. You might recall from a slide I showed earlier, 6 cuts were priced in the ECB. The default action for all central bankers was pushback. What did they do? Well, she delivered with it as expected, a complete shocker. Data continues to fall off a cliff. We've had a few reports last week on PMIs, etc. So that effectively leaves the euro US dollar supported in the short term, because the dollar seemingly in free fall, and the euro, they're even talking about hikes. That's quite preposterous. They're in all sorts of trouble. German manufacturing economy all over the place. The data was weak on Friday. The only tiny glimmer of light for them is into next year with the problems that are happening in China, and they're likely to export deflation. Germany's one of the biggest trading partners with China, so hopefully they can get that back into the system, and it helps sort the pricing situation out so that they can let the rates go. But in the meantime, ECB, Bank of England's Bailey, he also had little room to manoeuvre. I described it as the unwanted job of the week. Goods and services in the UK both proving sticky, wage inflation high. They've been going on about a tabletop mountain, the one in Cape Town. It goes up and across and then back down again. And that's what their plan for rates is. They've still got to convince. Market thinks that there's 80 basis points coming off again starting in June. GDP is struggling. It was touted as being flat to small down. It even missed that. It was off a couple of tenths of a percent. So they haven't really got anywhere to go. As I said, nowhere to run to. Sterling remains strong in the short term. So you've got the euro and sterling both set up to be stronger than the dollar. I imagine that is going to carry on playing out. The UK is stuck with a data-dependent situation into next year. And as a result, you speak to anyone that's really involved in the money markets and stock markets, the apathy reigns. No one is interested despite cheap valuations. And that probably explains why the FTSE, that's available on our platform, is stuck in an interesting trading range, but it's a sideways trading range, and that's probably going to continue into 2024. And then out of nowhere, we have Ueda of the Bank of Japan, aptly titled here, The New Unreliable Boyfriend. So for many a year, and we'll show on the chart later, the yen has been the funding currency. They've adopted this negative rates or low interest rate environment. And there's been chatter since November that they're about to unwind that. Now, that's quite interesting and dangerous at the same time, because there's so much money tied up in the carry trade. You can basically sell the yen at almost zero interest rates and then invest it elsewhere. So say in the States, 5% plus. That's quite a carry to unwind. And if they're about to change tack, things could take a turn for the worse very quickly. But they started pushing back on that explicitly, and hence is UADA the new Mark Carney. Mark Carney in 2014, I think it was, had to go in front of the Treasury Committee because he'd been so wibbly, waffly, all about his rate outlook. And he was described as being akin to the unreliable boyfriend, always got an excuse for why he's not turning up. So looking back now and seeing what the Fed did, were they actually doing a canny gamble that a lot of the hard work would be done for them, and they don't want to explicitly be held responsible for unwinding that carry trade. So to me, the PBOC, People's Bank of China, they've got quite a big problem, which might actually end up affecting the rest of the world. So it could be a reason for dollar strength in 2024. So in China itself, data is deteriorating across the board. No real focus, but we know that property's underwater. The bank has brought in debt stimulus measures this week, which can be a bit dangerous when you've already got deflation. That's something that I'll explain at length on another video, because that is interesting for when you're talking about stimulus. We've had Treasury Secretary Yellen talking about not decoupling the dollar from the Chinese yuan because that might cause bigger issues around the world. So has Powell done what he's done just to make sure that there's a semblance of liquidity around? And then we've got Donald Trump, never seems to go away. He's suddenly gone ahead in 7 key swing states. We're in the final year before their elections at the end of 2024. And his key policy is an import tax of 10%. So that's only going to cause further disinflation problems around the world. America can afford to go it alone. It's probably not most desired for the markets, but we'll see. Net overall, China could be a problem. So why does it matter? What does any of this waffle actually mean? Well, it's time for the market to move on to the next stage. Rate hikes, apart from what the ECB are trying to suggest, do seem to be over. And we've gone through this period last year where interest rates going up, really hurt the bond market, read through for the stock markets, all sorts of volatility, and it's now time to see what the fallout is. We're seeing below trend growth rates across the board. Generally, it takes 12 to 18 months to see the real impact of interest rate rises. So does that mean that we've got some deep sell-offs to come, or as suggested earlier in the piece, we're actually hitting that Goldilocks, in which case the economy will grow nicely, stock markets will rally, and interest rates will come flying off. In the very short term, it looks like we're set for the dollar to be weak, because the default case for everyone else seems to be that they're refusing to move rates. The dollar comes off, plus the fact that the Fed have actually moved towards 75 bips. They're moving in the right direction for the market. So what looked like being a race to see who could move first has been well and truly won by the United States. Moves me on to, I think, considering what the market's likely to do now. Santa Rally is forever on the media. And that, when it was originally created, was the move between Christmas and the New Year. So what will be the 27th onwards, only 3 trading days this year. So subsequent to that, all the rallies in December, despite being touted as being a Santa Rally, it's a bit of a misnomer. Having said that, the current reactions from the market have been relatively bullish, and into the year end, I'd expect that to probably continue. It's been a volatile week of news flow and of movements. If you're a price or swing trader, it's been difficult. Stop losses have needed to come to the fore. You probably had to use limits to get in and out of positions because the volatility has been so high. So it's been a very interesting week, and let's have a little summary of what's actually happened. So net, as we discussed, jobs and CPI didn't really have anything to move the needle, despite early worries about the jobs report. No change to what the market was suggesting and pushing on the massive rate cuts. The Fed didn't surprise, other than going the other way. No one really anticipated 75 bips over the 50, and other central bankers expected to push back, and they did. So net, as I said, weaker dollar is the way we're going. As a result, indices which are at or close to their tops should have enough momentum to have a couple more goes at getting there. The dollar environment is in the short term supportive, but I'm going to show you a few charts in a minute, and there's every chance that we are actually due a correction in a lot of these markets, even if medium term we're still going up. So let's be wary, because there potentially is a surprise to come, and the dollar itself, which has been the main driver for the year in both directions, is still in what is a positive market. It's still got a fifth wave of rising to go on, and we'll have a look at that in amongst the charts. So were there any chart clues out there that either predicted what was going to come this week, or actually how the market reacted to some of the developments? So we'll go through them with the charts, but just in summary, post-jobs report, there was a high in the dollar, which changed the whole outlook for the week, and had some very interesting, not often seen trading reactions, which we'll have a look at in a minute. Gold, that in general has been part of this whole weak dollar dynamic, but it's managed to sort of move away from that in the short term. It's doing its own little thing. And again, we'll have a look at what's going on there. We've suggested that sterling, GBP, the Bank of England, have got the least room for manoeuvrability, so they're likely as a result to end up being the default positive currency. Regardless of what the ECB say, the euro will probably have to start coming off at some point. But in the short term, the dollar is the weak boy in the room, particularly after Wednesday. And we'll see how that feeds through to some other markets, particularly some of the indices that have been close or above their near-term highs. But there's quite a few metrics that I look at, which is probably worth just mentioning, because things are getting quite extended. And then, as I said, the Bank of Japan came out of nowhere, and they've got their meeting tomorrow, which will be Tuesday the 19th. And they've been giving up some of their results due to the commentary, and let's see how that changed the chart on that. So again, without further ado, we'll move into the charts. So I've mentioned it a few times today, and to me, the dollar is the driver of most of the markets. You need to have a handle for what's going on there in order to see the read-through. So just looking here on a monthly view, all the way back to where Richard Nixon, not just famous for Watergate, but also for coming off Bretton Woods. So the US used to have a fixed exchange rate system. Well, the world had a fixed exchange rate system, but because the Americans were always bailing everyone out, there were far too many dollars in existence, and they thought the dollar was overvalued. So they wanted to come away from that. And then that also had ramifications for gold, as we'll see in a minute. But as you can see, initially, the dollar sold off. And then through the 80s, when they had these ridiculous exchange rates, double digits, we came up here, record high. And then most pertinent to how we're trading at the moment, the GFC 2008, 8-9 saw what has been the all-time low. So ever since then, we've been tracing out what is a positive environment for the dollar. Now, I like to look at markets in kind of Elliot Wave inspired moves, and you've got a 5-wave move here, an impulsive move. They tend to correct. Whenever you have a 5-wave up, you're looking next to have some kind of consolidation, which will be a 3-wave corrective. And Elliot waves are fractals, so you have waves within waves. Think of it like Russian dolls. You can keep peeling back and finding something else which looks very similar to the bigger one or the smaller one. But in the main, a high degree level here, it's pretty obvious there's been a decent rally from the 2008 lows, a 3-wave consolidation. Then we've had this impetus for the last 20, best part of 15 years, driving us up to what was the October 22nd high in the dollar. It's at the same time, which is sort of similar to the low in the stock markets. And then since then, we're in a wave 4. So the dollar has actually been selling off in the main. We had this year's jump up to that B level, and we're currently in the sell-off phase, looking to put in another low, which is what it has been driving, and is now the narrative working backwards. I like to look at a combination of the fundamentals and the charts rather than each one arguing with each other. Let's see where there's crossover and support. And this chart has been demanding a weak dollar, and we've been looking for a reason to make that happen. The Fed has almost cemented it that in the short term we are going to get this wave 4 low. But in any case, this is looking at a monthly view, quite difficult to see the full detail of what's going on. But let's drop into a shorter time frame. So on the daily, for instance, I said we've had that third wave rally which ended in October 22. We have been tracing out what looks like a pretty obvious three wave, and within these there are three waves again, and a corrective always ends in a 5-wave move down, of which we look like we're only halfway through that. I like to look at markets in the first instance of a corrective of being equal legs. So the A leg will always equal the C leg as a starting point. So taking the move from there to there, starting at the top of B at the October 23 high, just before the market started rallying again. We're looking for the same 100% down, which takes us, anywhere between 98 and 91. I like to put it as a first instance between the two important fibs, the 0.618 and then this equal legs 1. So we've still got quite a bit of weakness to come, and that's hopefully going to happen in the early part of 24 and get us off to a rally. And as I mentioned before, the non-farm payrolls report on Friday the 8th did have a little bit of impact on the short-term trading, and I'm sure many of you will have been messing around in euro dollar, etc., etc. I mean, the reason I like DXY is it has a 57% weighting to the euro anyway, so you do get quite a lot of crossover there. But anyway, we're trading. We've discussed how we're in this last final 5 waves down. We've had one, and then it looked like we were doing a 3-wave consolidation, which was quite a steep move to give us the first leg of the 3. And here we are, we're trading around, and prior to the non-farm payrolls report, which got this zoom up here to 104.2630, it looked like we were doing a 3-wave again down to consolidate for the B leg. So we're going down here, up here. Everything looked like we were having another final sell-off, looking for a little bit of short-term weakness. But then it was all reverse engines. But rather than break through with the dollar strength, everyone thought this probably was a clue as to what was going to happen in the rest of the week, because it held the level. So we're looking for that breakthrough, another up leg here before we finally got the third leg of the 5 down. But look at this, and I was messing around on the systems here with some stop losses, and you had 3 attempts by the DXY to break through that high and take us to a new level, which we would have been looking for 1+1. So a good chance here, and it is even doing some preliminary from the November move to here. The old equal legs ABC would have taken you up to 105, but we didn't get any of that. We had 3 attempts, 2 of which failed by 1,000th of a point. It's absolutely incredible to get such a steadfast support line in there, or resistance line in. But as we've seen, that looked like very much on Monday evening like people were beginning to get wind of what was going on for the week, and we have since traced down quite aggressively into a third leg sell-off down here at 101.8. But despite the fact we've been rallying, my central case is that we've still got more sell-off to come. And we pointed out this is just a rough diagram, but I'm actually expecting it to go much lower. As I said before, the equal legs 0.618 takes you down into the low 90s. So look out for that. So moving on to gold, pretty much as I suggested on the dollar chart, things started getting interested in the 70s when they moved away from the fixed exchange rates. So really, we've been in a bullish pattern ever since then. So we had the first move up into the 80s, strong, and then the sell-off again into the crash into the early 2000s. Since when we had a massive move up in Elliot Wave, the third waves are where the action really happens. I call it the daddy boy wave. And then subsequent to that, we've had what was the 2015 low, and really most of the price action and the charts are really based off what's happened subsequent to that low, and that's where we'll continue. So since that multi-year low in 2015, we've since had a triple top, multi-year high, and really in 2020 post-COVID fears, we hit a high in gold up here, which is taken until now to really look like we're going to break through. But since then, we've had a consolidating phase, very clear 3 waves here to the October 22nd low. And now we're expecting to move up in a 5-wave pattern, of which we're very much only at the start of that. Now, in commodities, when you look at wave theory, you often get an extension in the fifth wave. In most other markets, the big daddy boy that I mentioned before happens in the third, but there's every chance that we're going to get a lot of the upside price action because we're in a fifth wave, and we'll discuss in a minute where we are within that wave. So I've said before about technical analysis, it's all about time frames. So we've had a look at 12-month and weekly, and we're dropping into the daily now. And often we'll look at the hour and then 15 minutes. Not all of those things will be pointing in the same direction at the same time. But why I like using Elliot Wave is because it's very much a market sentiment engine, and it's all about best fit. There's more than one alternative, and it has lots of rules which help you boil down to what's most likely to happen. We're never going to know for sure, but also it's about protecting your ability to trade, stay with your account, not blow your challenge, just as much as making. And I find Elliot Wave creates lots of negative probability situations that can't happen, and therefore it's very useful to use as a backup tool with the fundamentals and other technicals and indicators. It's not about one thing always wins. People forever go on about having this best indicator or best setup. They're going to work sometimes, they're not others, and it's a combination. It's a long-term game. We're trying to put it all together. So here we are on the daily of the dollar. We've talked about that being a major low in October 22, and we're now at the start of a much higher degree, the big dolls, as it were, of those Russian dolls. A fifth wave. If you look at that 12-month view, there's still one more big wave to come to complete the overall 5-wave moves up. But we're very much at the start of that, and it's about trying to identify the 5s and 3s, and then the labeling kind of takes care of itself. But we know that in the first instance, it's a lower degree, and it's how that builds up. So where people argue a lot in Elliott Wave, it's about whether they see 3s or 5s. So here, I think you've got a clear 1 up, a consolidation, a 3, a consolidation, and then a 5 to create that first wave, and then a pretty clear 2 wave. Now, within waves, they often extend. So what people might say here is that there's a 1, 2, 3, 4, 5, 6, 7, which that's just a 3 followed by another consolidation and a 3. And when you're dealing with the 5s, the upside, it can be 1, 3, 5, then it goes 5, 9, 13, blah, blah, blah. So these things extend within themselves, and it's our job to look at the time frames where they're showing up. But in any case, it looks like we're in a third wave at the moment, is the most likely situation. So the gold chart on a daily basis is a classic of how there's more than one current alternative, and they both, fortunately, are going to get us to the same place with a bit of luck. So let's get it. So if you're really bullish, remember we're in a fifth wave overall, and then we've finished the second wave there. So we're now entering a third wave within a fifth wave, which I said can extend. So we're expecting a third wave to do lots and lots of action. And one way of looking at this is that you've had a 5 here to give you a 1 with a pullback for a 2. And then rather than the next wave being a 3 of the same degree, it's likely that it's so impulsive and quick. It's what they call nesting. So you get another 1 with a 2, and then you're looking at big moves on 3 of 3 of a third wave within a fifth wave. So the more you build it up, the more powerful it gets, and that we're in a very, very interesting place, given the fact we expect breakout in gold to new all-time highs. That's not a scenario that you're willing to take on. So if you're shorting gold in the short term, you need to be aware that it could massively break on you at any moment. So make sure your stops are pretty tight. So fib extensions become useful here. So if you do believe you've got a wave 1, then the third wave, starting from the bottom of 2, should be a 1.618 advance, which you can see from the diagram here, gives us a target for the black 3 around 22.50. Now, equally, if we're doing that nesting and we've had another 1 and a 2 pullback, 1.618 of that extending 1 takes us all the way up to 23.18. So combination that they're in a similar sort of ballpark. I'd hazard a guess that that's quite an important level that we need to keep an eye on. But against that, there's another way of looking at this advance, and we'll move over to that on a different page in a minute. One sec. So in time-honored fashion, here's one I prepared earlier, and it's the same setup, but looking at it in a slightly different way. So some people, like say, identify the threes more than the fives, but that is quite a valid situation. If this is an overall move up that is a first wave, it can be what's called a leading diagonal, of which that is 5 lots of 3 going up, obviously impulsing up, retracing to get the final move up. Now, there's a lot of powerful arguments for this. If you've got to put a trend channel in there, the top of 1 and 3 are quite important, and then that allows you to pull it down to 2 for a parallel channel. So we are trading within that channel, and it all becomes fairly instructive. So you've also got some target zones there. So if you join up the end of the last move and see how it went through 2, that's creating what's a converging diagonal within that channel. So it all starts to get interesting, starting to become relevant. We've had a 3 up, we've had a 3 down. That moved to the extreme at the start of 2 weeks ago. That really shot and took out the multi-year triple top. That could well be the 3 of 3 up there, and we're now halfway back of retracing the next 3 down. So in which case, despite the overall move that I was talking about still going to be ultimately higher, we are dealing here with serious pullbacks. It's quite volatile within this channel. Waves 2 and 4 within a leading diagonal are normally zigzags, which means that the first leg down and the third leg down generally are the same length. So to stay within, I was kind of working it backwards to stay within the channel. Where do we have to see the second leg get to almost have 1 for 1 still within there? And that implies, short term, we've got the weak dollar maybe having a little run into the end of the year, but we could equally then have quite a pullback before we ultimately go and take out the all-time highs. So 2 things more or less saying the same thing, but again, we're now in a situation where we have to have tight stops in both directions. And then finally, we've got the 1 hour chart I want to have a look at here, because this is quite instructive to show. Here I am giving it the big one, and yet I'll show you how it's so easy to make some mistakes. So I was looking at this in terms of the ABC, one of the ABC rally situations rather than the 1-2, just testing it out. And obviously, I started to look at the RSI divergence here from one high within that A to the final A. So it looks like we're giving up a bit of momentum. So we're expecting a little bit of a pullback. So I'm in there, but I'm still wary that we could still take out the all-time high again. So I'm looking at this, and it's trading around, and I've decided to put in a stop loss. I'm short here. I decided to put a stop loss in at the previous high in the current move, whereas the previous high for the whole move there, scrolling across here, was a tiny bit higher. And I've ultimately got stopped out here an hour before, when I'm eating my beans on toast for lunch, and suddenly getting an alert that John Williams has started speaking from the Fed, one of the most respected guys, pushing back on the interest rate moves, and we get a little collapse. Now within that, I also tried to sell again when it jumped above 2041 while it's being digested. System not letting me in, couldn't get the thing to work, blah blah. So I ended up missing that little move down there, but not to be thwarted. I'm coming back in again later, but I'm not going to miss out this time. I'll use a limit, because that's the best way of entering in these volatile markets. So I go through the system, put it in, and I'm sort of hardly thinking. I'm going in minimum lot size just in case it comes flying back up. And then I get a fill, and before I know it, I've got an absolutely massive loss. And it turns out it picked up my previous position on the NASDAQ, and I'm 6 times bigger than I should be, and panic stations could get wiped out here in seconds. So none of this trying to manage it, and ultimately if I'd have left it, I could have made decent money. But you've got to put a line through it, be disciplined. It's a mistake, and there you go. So I share your pain. It can be disciplined. You have the right position, you still get stopped out, but net in the long term, that is the right way of playing the markets. You will get the wins if you time it right. Be judicious with the levels. Make sure you're picking the right one. Don't try and be too clever, and then double check everything before you're entering. If we're rushing in too much to put the trade on, then ultimately we're going to make mistakes. And I'd just like to quickly go through a couple more charts that are just instructive in the short term. as to some things that are going on. So we talk about the dollar. It's breaking down. We think we're getting a lot more downside down here, sub 100, and that's confirmed a break of the previous low. The euro, US dollar, remember it's 57% of the DXY. That's still not confirmed. The break, confused by the weak data perhaps that we had on Friday, but really from everything that happened last week with Lagarde still talking about hikes and the Fed opening the door, that should have confirmed it by now. But keep an eye on that. So the real engine of growth in the indices this year has been the NASDAQ 100. I'm just taking a look at the future level on that. That's the one that's taken out the all-time high. Now, again, I've said before that when you're looking at the relationships between waves, you want to try and see whether there's any patterns there, whether things have topped out. So 1 repeated from the bottom of 4 here was suggesting 16,000. That's long since gone. 1 spot 618 to suggest that this wave might extend is a target. So keep an eye on that because we're in that space at the moment. But it's another non-confirmation index because if you go back to the actual CFD on the 100, that's still, it's close, but it's not quite taken out the all-time high. Very, very close. So it's not confirmed what the futures have done. Probably a lot to do with the roll. And then the NASDAQ composite, the overall tech index, that's nowhere near. Absolute divergence here. We're a good 10% away. So, you've heard lots about breadth, but that shows you that the NASDAQ is getting extended. There's potential for a little bit more rally in the short term, but let's just be aware that not everything's confirming within that space. And very quickly through a couple more of the US indices. The Dow Jones, that again has a non-confirmation, which means that the post-Santa rally could end up fading. So if you look at this, the Dow itself has gone to a new high, but the transport index within that, which is a major component of the Dow, and there's this long-term thing called Dow theory. Once them both moving at the same time, you've actually got divergence. So the transports have been falling while the major index itself is going up. So that's one to watch out for. Similarly, the McClellan oscillator, that's showing lots of divergence. Every time we've seen rallies going up for previous parts of the year with the McClellan oscillator going down, very quickly had a reversal afterwards. So just be careful. That's something to watch on the horizon. Again, if you look at the summation part of that index, then every time there's a serious peak, that's been a top of the market this year, and we're approaching another peak. Interestingly, the two deficits this year have both been significant lows. So quite a decent indicator to follow. US 500 index, it's not necessarily a sign of top, but it's a sign of us being top-y, and that is the number of stocks trading above their moving average. So it's a diffusion index around the zero is actually 50%. So add on whatever this indicator is showing above 50 to show you. And look, it's very close to 90. Last time we had anything like that was in July, and you know what happened next, we came crashing off. So it's not necessarily a definite turning point, but it's showing you that things are getting stretched. And then the final chart I want to talk about today is the US dollar, Japanese yen. We had quite a serious 5-wave move ending to the upside in November, and that's around the time that all the chatter came that the Japanese might be changing their outlook about the low interest rate environment. So not surprisingly, the yen started rallying. And we finished this ABC pullback down here in early December, and then that's when Ueda came into his fore and started sending his officials out to push back on that, saying that they didn't necessarily agree. So that really got to work. And at this point, it looked like we might actually around here be going to do a double correction here to complete it. But what happened? We had all the data, we had CPI coming in, and the meetings came out, and as I said earlier, it looks like the Fed did the hard work. Japan have pushed back, and the Fed have gone and done everything to make the actual sell-off in the dollar yen come to fruition. So they must be over the moon, but it just shows you how things get backfilled. You need to be aware that it's not always going to be a straight line up, and data can come out and change it. That's why we always want to have an alternative. but well worth keeping an eye on for this year, because as I said, it's been a long duration carry trade for the market, and there could be some really deep sell-offs in this dollar yen if they do anything to unwind that. So we're nearly there. The summation of the charts we just looked at, the dollar still has a bit of short-term downside, but we are due one more big rally to a short-term top. So be very careful of that in the new year. For now, indices can still party like it's 1995. That's something that we'll come back to on another day. Gold is volatile, but net, whichever way you're looking at it, even if it's got short-term downside of 5%, that's probably a buying opportunity. Gold looks like there are new highs on the way. And going into 2024, what could sidetrack the markets? Well, the yen carry trade isn't a given, and it's not necessarily a positive. And you've obviously got those Chinese issues hiding away as normal. So net, keep trading, but be careful. Use the stop loss, use the limits. But going forward into new year, we'll be doing all sorts of short-term, long-term analysis, dipping in and out the market, telling you when things are useful, when they're happening, what to avoid. And if you've enjoyed this or you've got any advice of things that you'd like to see, please get in touch. But for now, I'd like to leave you with an old friend from Hill Street Blues.
That's it. Let's roll. Hey.
Let's be careful out there.